This is Ask Todd on the Financial Exchange Radio Network. If you have an existing estate plan or are in the market for one, Todd Lutsky is here to answer your questions and help you plan for later life. Ask Todd is presented by Cushing & Dolan, serving Massachusetts and New England for more than 35 years, helping families with estate and tax planning, Medicaid planning, and probate law. Visit CushingDolan.com. Now, here's Todd Lutsky.
As promised, Todd Lutsky now joins us from the law firm of Cushing & Dolan. We got phone lines open because the segment is Ask Todd. It's your chance to ask Todd your estate planning questions, and he'll actually answer them. Yeah, it's not just you asking, it's him answering as well. Phone lines are wide open right now at 888-205-2263. That is the number to call to ask Todd your estate planning questions. Again, it's 888-205-2263. We can normally get through 2 to 3 questions, so get calling early, get calling often to make sure we get to your question for Todd. Again, that number is 888-205-2263. Mr. Lutsky, how are you doing today?
I am doing just fine. How you been?
Good. I had a busy day yesterday.
Yeah, what are you doing?
I was shopping for cherries and a new microphone stand.
I don't know how cherries and a microphone stand go together.
Bada bing, bada boom.
Oh, there you go.
Yeah, it was good.
Yeah.
Todd, want to talk to you a little bit about gifting strategies. When is it appropriate to incorporate annual gifting into an estate plan? What role can that fill, and when do you start to see that talked about as something that makes sense for someone?
Yeah, I think that's fair question because this gifting guide really explains that. But, I mean, just because we have this ability to gift away $13.9 million, which, by the way, that is our federal estate tax exemption. You've heard us talk about that many times. It is also our gift tax exemption, right? You get to use up that exemption either by dying, which is not usually on the to-do list, or by gifting before you lose it. That's when tax laws change, right? So, but just because you can gift away $13.9 million and pay no federal gift tax, and remember, there's no state gift tax in any state except our neighbor, Connecticut, is the only one that I'm aware of that has that. So otherwise, you don't worry about state gift tax. But I don't want to just gift because there's capital gains taxes that you have to worry about, not just death taxes, right? So if I'm going to gift away an asset, I first want to make sure that I'm getting a federal estate tax benefit, meaning if I'm under $13.9 million or married and double that exemption, right? What's that, like $28 million and change almost? So it's called 27 and change. I probably don't need to gift to save federal estate taxes. And remember, the federal estate tax rate is 40% of the amount over the exemption. All right, well, if I'm not saving that, and I'm only saving the state estate tax, and I'll just use Massachusetts as an example, I'm only saving, say, 10 to 12%. And I end up giving away assets that have capital gain built into them. I bought a house a long time ago. You know the drill. I got a rental property that I depreciated to zero. And now it's worth $1 million. Well, I got $1 million of gain built into this property. If I give it away and I'm not saving the 40% and I'm only saving the 12%, but I trapped almost 30% long-term capital gain in that item so that my children will pay that when they sell it, I'm not sure that's helpful, right? 28, 30% versus 10%. Not a good math situation. So think about what you gift and why you're gifting. If it's just to save estate taxes, might want to double think it.
Talking with Todd Lutsky from Cushing & Dolan. Still have room on the phone lines at 888-205-2263. That is the number to call to ask Todd your estate planning questions. We are going to take a quick break right now, but when we come back, it's going to be right to your questions with Todd. 888-205-2263 is the number. Again, it is 888-205-2263. Quick break, then your questions with Todd.
Ask Todd with Todd Lutsky every Wednesday at 10:30, only here on the Financial Exchange Radio Network. You're listening to Ask Todd with Todd Lutsky on the Financial Exchange Radio Network.
All right, let's get right to your questions with Todd Lutsky. First in the queue, we got Marty in Framingham. Marty, what is your question for Todd? Marty, are you there?
Yes, I am. Thank you for taking my call. My home in Medfield had a fire. It was totaled. Although it was fully insured, it's going to cost me about another $200,000 to build the house back the way we want it. I've got the money set aside that the insurance company's giving me, but it's going to cost me another $200,000 of revocable money or other money to get the house the way we want. The question is, I don't want to interrupt the integrity of the irrevocable trust, which has been in for like 7 to 10 years. So how do I fund it without interrupting that irrevocable trust?
So it seems to me that since the insurance company paid you, that means that when you set up the trust, you told the insurance company to add the trust as an additional insured, correct?
Yes.
So
that's all set up in it. I'm sorry, go ahead.
So because you told the trust to add since you told the insurance company to add the trust as an additional insured, you should go back to the insurance company and tell them to issue the check, pay to the order of the trust, not you. And that way it goes directly into the trust and there's no resetting the 5-year clock. In other words, it should be no different than when you sell a house, right? If the trust owned the property and you decided to sell and buy another house, which we all know you can do, out would go the house to the buyer, and in would come a check made payable to the trust, because the trust then would receive the money, and then that money receiving that money would not reset the clock. In other words, if the house went in 7 years ago, to take your example, and now that house is 100% protected from the nursing home, and you sell the house and get money in the trust, that money is 100% protected from the nursing home. And the buying and selling does not reset the clock. Okay? That's crystal clear. However, in this case, if you've lost the house, which is kind of like a sale, it's gone, and in exchange for that being gone, the trust is going to get paid. What? It's going to get paid the insurance. So now in comes the money directly into the trust. Well, there may be no house there anymore, like a sale, but there's money there. Well, that money should not reset the clock. And then you can use that money to start paying the contractor to build the new property. Now, as to the additional $200,000 that you need, well, if that's not already in the trust, like maybe you put a portfolio in or an investment account in or something like that, if that money is not already in the trust, well, then yeah, you're going to have to contribute that money to the trust to finish building the house. So worst case scenario here, I see that there might be a new 5-year look back period waiting, but only for the new addition, only for the new $200,000 that you put in the trust. So does that help a little?
Yes, sir. It does.
So get that changed go get that check reissued by the insurance company. That's what I would do. So hopefully that helps. And folks, I'm so glad to hear that he did his planning and had the house, where it belongs. But for other folks that haven't done all their planning yet and are thinking about I'll just do a quick fix, I'll give away my assets. Well, you can. That's what the law says. Might not be the right thing to do. So there's a guide called Making the Most of Gifting Assets. Sometimes you want to give things to irrevocable trust rather than children outright. You got to think about what kind of asset I give. A high basis asset versus a low basis asset. Maybe for higher net worth people, we want to give away a lot of assets. Well, I don't want to give them away and not enjoy it. I worked my whole life for it. Well, spousal lifetime access trust might be the way to give away assets and retain some ability to control and enjoy what you gave away, right? Think about pooled trusts. Think about special needs trusts. So there's all kinds of ideas and ways to gift or maybe not gift at all. And that might be the right answer for a lot of people. Call and get the guide, folks. We're getting near the end of the month. It's going to go back in the vault. 866-848-5699 or legalexchangeshow.com. Again, 866-848-5699 or legalexchangeshow.com.
Got another one for you here. Let's go to Dan in Florida. Dan, what is your question for Todd Lutsky?
Todd, first of all, I'm a Massachusetts resident.
Okay.
And I'm trying to shelter my holdings from the mass tax.
Okay.
Does an irrevocable trust do that?
So it depends on the kind of irrevocable trust. So let me explain. First of all, are you married?
No, I was married. She passed away.
Okay. So how much are you worth in total? Round number.
$4 million.
All right. And I'm assuming there was no planning done when your wife passed. No trust planning.
We both had revocable trusts.
Wonderful. How much of the $4 million was in your wife's revocable trust when she died?
None.
Oh. So this is exactly what we talk about all the time, right? On the radio, we tell people funding a trust is so darn important, right? If you don't fund a trust, it really is just a waste. It's a bunch of paper doing nothing for you, which is why we stress funding it. And I'm going to say, obviously, it's water under the dam. I get it, but at this point, I just want to help other people learn. So because nothing was in that trust, my hope for you, Dan, on this one was you were going to tell me, oh, yeah, we managed to put about $2 million worth of assets in my wife's trust. Well, if you had done that, I would imagine that trust is designed to hold a remainder share and a marital share. And then that $2 million would be tucked away in your wife's trust, subject to tax when she died. She has a $2 million estate tax exemption, so there's no tax due. And then when you die, you would only be taxed on what you own in your trust, which would be the other $2 million. And now, like magic, if you died, you're under the $2 million because the assets tucked away in your wife's trust would be sheltered from estate taxes and not included in your estate when you die, even though you would be controlling and enjoying, perhaps, what's in that wife's trust's bucket. And then when you die, you're under $2 million, and lo and behold, you pay Massachusetts 0 estate taxes. So, folks, that's for everybody who hasn't done their planning yet or have done their planning and didn't fund one trust. Please learn from this call what we can do in the future. Now I turn to you, Dan, and I say, well, I mean, you got $4 million worth of stuff. At least you got to step up in basis. How long ago did your mom die? I'm sorry, your wife die?
2 years ago.
So it's not horrible. So 2 years ago, you got, if you own things jointly when she died, and I'm assuming you did, right?
We didn't.
You didn't own.
Second marriage.
Oh.
It was a second marriage, and she had her trust. I had mine.
I see. But nothing was in her trust. So how were the assets owned? Everything was in her name alone?
Yes, she owned her own house. I owned a couple of houses. They're both in my name, and hers was in her name.
And did her stuff go to her side of the family, or did she take care of you with any of it?
It went to her side of the family.
Oh, okay. So the $4 million you have is just your assets.
Yes.
Oh, okay. So again, the explanation is still very helpful for people, but in your case, you're worth $4 million. Again, we're thinking about, do we need to make a gift? Well, I don't know. You have to really analyze your assets. We just did that example that maybe giving away assets now just to save 10% on the amount over $2 million or 12% on the amount over $2 million might not be the most tax efficient thing to do. But if you have cash, CDs, kicking around, and you want to set up a gifting trust for your children, and you don't mind giving it away, that would be an easy fix because there's no loss of a step up in basis with cash, and that money can be tucked aside outside your estate for estate tax purposes, thereby reducing your estate tax liability. But just sticking them in an irrevocable Medicaid trust to protect them from the nursing home would not reduce your estate taxes. But might not be bad planning for you to protect your assets for your children. Sorry we're out of time, but I hope that gives you a little something to think about.
Mr. Lutsky, thank you so much for the time today.
Always a pleasure.
This has been Ask Todd on the Financial Exchange Radio Network. Ask Todd with Todd Lutsky has been presented by Cushing & Dolan, serving Massachusetts and New England for more than 30 years, helping families with estate and tax planning, Medicaid planning, and probate law. Call 800-393-4001 or visit CushingDolan.com. The views expressed in this segment are solely those of Cushing & Dolan. Armstrong Advisory does not provide any legal or tax advice. Please consult with your legal or tax advisor on such matters. Cushing and Armstrong do not endorse each other and are not affiliated.